Record.
Well, good morning, everybody, and welcome to the July Inner Circle Workshop. I'm Brad Gatto. If you don't know who I am,
I'm Matt Stillha. If you don't know who
that's
I am.
good. I'm going to let you introduce yourself there, Matt. We're excited to have all of you here. Here we are in our matching t-shirts again. I laughed last time we did this. I feel really backwards because I'm left-handed and you're right-handed. I feel like we should switch. Can we switch? All right. Is this better, guys? Does this feel like more like it's supposed to? We're excited that you're all here. If you could do us a favor, as always, jump in the chat box, make sure it's just kind of an audio visual check. Can you hear us? Can you see us? Because we can't hear you and we can't see you. So for all we know, we're talking to nobody right now, even though there's quite a few of you in here. So it is, what is the date today? The 27th? Yeah, Wednesday, yes. July 27th.
Yes.
All right. Thank you, Jeremy. We appreciate that. Good morning, Tom.
Hi, Courtney.
Hi, Courtney, Gary. That said, this month's Inner Circle Workshop is understanding market volatility. And so we're definitely going to get into that. We have a fun and friendly quiz for all of you. If you've never been part of our Inner Circle Workshop before, and this is your first one, first of all, welcome. We're excited that you're here. These are meant to be educational. They're meant to be kind of lighthearted. And so, yes, there's a quiz, but this is not graded. Nobody knows your exact answers. We're going to do this today. There's a group. Good morning, everybody. Thanks for saying hi. We appreciate it. That said, we'll get to that in a second. We have some housekeeping items up front. We're going to get to the quiz, and we're just going to walk through the quiz together. This month's topic, again, is understanding market volatility, because there's been none of that recently.
No,
so,
zero.
Yeah. But before we do that, just a couple of things going on around Fiat these days. And so as always, what I'm going to do is I'm going to share my screen with you, and we're all going to go out to the Fiat website together. Share. All right. You should be able to see my screen. And on my screen, I'm going to go back to the homepage so you know how I got there. This is the Fiat website if you've never been to the Fiat website. And by the way, if you are new, again, welcome to your first ever Inner Circle workshop. There's a lot of you on here. I'm seeing names of people that join us every month, and we love you guys. I don't know what it is that we're doing that makes you come back every single month, but thanks for hanging with us. This is one of the funnest things that we do, in my opinion, is be able to kind of provide some education, because all this stuff's out there, right? The internet's a thing. You guys could go seek out all this information without us. But one of the things that Matt says all the time that I appreciate is there's no lack of information out there. There is a lack of wisdom of what to do with that information. And so what we attempt to do in these workshops is to provide some wisdom around that education.
We end up learning a few things ourselves as well.
We always do.
Yes.
We always do. No, we don't. We know everything.
That's
Matt.
right. That's right.
Just so that you know, if you've never been out to our website, there is an About tab right here. I'm not going to go to that today. But what I'm going to focus on is the Education and Events tab. So from an education perspective, if you don't know this already, we have a blog post, if you scroll down here, that we put out quite often. In fact, since the last Inner Circle workshop at the end of June, we have put out 4 different blog posts. Right here, 7.6, Investing During Troubled Times. And then these last 2, how do rising interest rates affect me? And then 7.27, signs of a recession. So 3 of the 4 blog posts are fairly timely about kind of what's going on, things to be paying attention to in the markets and things like that. Matt and I are very well aware that headlines can drive fear and anxiety and things of that nature. And so we attempt to try to put as much information as we can out there to, again, do the same thing we do in these Inner Circle workshops in a blog fashion of providing wisdom around some of the information that's out there. Also, in education, if I go back here, there is our podcast here. If you're not subscribed to our podcast, what are you doing? I'm kind of joking, but not really. I mean, seriously, what are you doing? Every day is Saturday is the name of the podcast. We've had 2 episodes come out. One is introducing you to Ashley Milo as our COO. That's a fun episode. And then one of the visions that Matt and I had for the podcast when we started it early last year, because the name of the podcast is Every Day is Saturday, was telling the stories of the people that we've met, not just through families that we serve here at Fiat, but just through life that we think are living that every day is Saturday lifestyle. And that doesn't necessarily mean they're retired. It could be that they're working, but their job isn't necessarily a job to them. And so we're going to start building that into the cadence of our episodes. And so this most recent episode, as you can see right here, Living Every Day is Saturday Life with Jason Suss. I'm not going to steal the thunder of that episode. If you want to know who Jason is and how he's living this every day is Saturday lifestyle, you're just going to have to listen. It's a super fun episode. A lot of our episodes are, in that 20-minute time range. This one's a little longer than that, but that's because we were having so much fun talking to Jason.
Fun fact, Jason actually plays a role here as well. I'm not going to tell you what it is. It's a very temporary role, but we'll let you figure that out when you listen.
A lot of teasers. I love it.
Yeah.
All right. And so last but not least, in the events tab, what's coming up? What else can you be a part of here at Fiat? So next month's Inner Circle workshop, I'm going to click on the upcoming events in the Inner Circle workshop. Next month in August, the Inner Circle workshop is Wednesday, August 24th. So mark your calendars. In fact, if you want, you can just hit the registration button right here and you can register right now for the upcoming workshop next month. Preparing for retirement, specifically talking about the ever vaunted Social Security.
Yep.
It's going to be, we're going to try to make it fun. So, Social Security isn't the most interesting of topics, in my opinion, but it is a part of every one of our lives, whether you're retired or not yet retired. And so kind of understanding Social Security, everything from kind of when it came into being, how your Social Security benefit is calculated, all the way down the road to when you're filing, what should you be thinking about, when should you file, how does that kind of overlay on top of the rest of your retirement planning. We'll kind of cover most of that in next month's Inner Circle workshop. So there's that going on. Also in the events tab, we have happy hours here, as you know. Next month's happy hour in August is August 25th. Now, we know not all the families that we serve are right here in the state of Minnesota. And so this is not a virtual event. This is a live event in our rooftop patio that we have here. if you want to fly in, be our guest, we would love to have you. We don't expect it, but for all of you local families, if you want to join us in August, we would love for you to be there. This one's a little bit of a special one, a little bit more of a nuance of the August happy hour. Do you want to, do you know why?
No, I don't.
I was going to say, do you want to tell them, but maybe you don't know.
You're looking at me.
That's really funny. Let me share a different screen with you and I'll tell you why. Stop share this screen. Now let me share a different screen with you.
Oh, yes. Look at this.
Oh, that's the wrong one. That's actually, that's really funny that's the one that popped up. This one. Share. It still took me to that one. I'm going to try something different here, folks. Hang with me. Matt and I have never professed to be the most awesomest of. So we'll do this, and then we're going to slide over, maybe. Oh my gosh. Somebody turn on circus music. Where did that page go? Not that one. That one's coming up on the inner. There
we go.
Goodness sakes. Finally got there. Matt's been making me talk about this for months and months. And then when it finally actually comes time, he has no idea what's going on. So in the happy hour, it's actually gonna be our book launch party. The book comes out on August 16th. I'm super excited about it because it's done.
Yes.
It's been 18, 19 months in the making. And so we will have physical books in hand and kind of make it kind of a fun book launch party as well on top of the happy hour. So if you want to come and be a part of that, we would love to have you. And that said, on August 16th, the book is available on Amazon. So if you want to go out and purchase the book on Amazon on August 16th and leave a review, I would be much indebted to you.
This is quite funny. If you've been joining us, you know that I bring this up each month and Brad doesn't. And if you're joining us for the first time, this is the first time he's ever actually talked about it. So.
Well, that's because it's actually done. Yes. I don't like talking about things when they're still in progress and I don't have dates and all that other kind of stuff. But now that it's kind of locked in fact, yesterday I had to actually order the physical copies of the books and decide how many we wanted and all that other kind of stuff. So I know what's happening. I know what's coming. So that's what's going on around Fiat. Anything that I'm missing here or that?
No,
I don't think you have any idea what's going on, obviously. So what am I asking you for? That said, we're going to get into our fun and friendly quiz and jump into the content for today. We've had somebody trouble getting into the podcast. If you have trouble getting into any of our stuff, just let us know. Not Matt and I, because we have no idea how to help you, but there is somebody here at Fiat that does know how to help you. The podcast is on all of the platforms. And so whether it's you're listening through Apple or you're listening through Spotify or really anywhere you can get a podcast, Amazon, it should be on all of those platforms. And so to the family member, the Fiat family member that brought that up, just reach out to your advisor and get you in contact with somebody here and we'll make sure that you can get access to the podcast. So that said, I'm going to pop up the quiz. Again, if this is your first ever Inner Circle workshop, what's going to happen is I'm going to pop this quiz up on the screen. We're going to give you about 5 minutes to take this fun and friendly quiz. Do not stress out about it. Who cares if you know the right answers? It's just an easy way and fun way and interactive way for us to kind of walk through some educational content rather than just talking at you for the next 45 minutes. So I'm going to pop that up. We're going to give you about 5 minutes. There is no background music because when we post these on YouTube, we can't get the rights to play these songs that we've been playing in the past. So I'm going to shut my camera off.
Lesson learned.
And we're going to put this this poll or quiz up.
I do have a dad joke before we jump in.
Oh, yeah, we always do a dad joke.
Friendly. All right, you ready? I think you might get this one.
Okay.
How was the city of Rome split in two?
I don't know.
With a pair of Caesars.
Oh my gosh. Thumbs up or thumbs down in the chat, that dad joke. I've never heard that one. I've heard a lot of dad jokes. I've never heard that one. All right, here comes the poll. All right. About one more minute. We're gonna take the fun and friendly quiz down. So get your answers in. All right, we are back, and I'm going to end this poll. End poll. Here we go. Hopefully, all of you got your answers in. I gotta tell you guys all the truth. Matt and I, when the cameras are off, we're sitting back here reading dad joke books and laughing our faces off here. So we've got some good ones for you coming up in future Inner Circle workshops. And if you're lucky enough at the end, I'll give you one more. So, all right, let's jump into the content for today. So let me share results with you here. We're going to start with question number one. Matt, take it away.
I'm going to start with question number one. The oldest known financial market bubble is, the options were the Wall Street crash of 1929. 60% of you selected that. 13% of you selected railway mania. 0% selected the Mississippi bubble, and 27% selected tulip mania. This is a fun and friendly quiz, but as
drum roll, please.
Yeah. As you know, I love it when we trick you.
Matt and Brad won.
Yes.
You attendees guys, 0.
You guys 0. No, the reason we love tricking you is because that means you're going to learn something new today. So it's still fun and friendly. The correct answer is tulip mania. So Wall Street crash in 1929. And by the way, these are all real things. And the reason we put financial market bubble and not stock market bubble is because preceding the stock market crash of 1929, there have been other booms and busts. So other different financial instruments. So let's just go through them. Railway mania. So that took place in Britain in the 1840s. And that was the equivalent of the tech boom that we've seen today. So, railway was a new technology. Britain had plans to build out 9,000 miles of track, and
some of it like very opulent, not just like, practical railway stuff. Like they, of course, when people globbed onto it, they realized that there was money to be made. Then it was like all of a sudden it was like all these super fancy railways and all this sort of stuff. But
yep.
A lot of railways.
So a lot of railways. But so that was bid up so high, and you'll see a similar pattern throughout all these, that everything. So what was Greenspan's irrational exuberance?
Yeah.
So Alan Greenspan, that was a phrase that he coined. We'll see this pattern play out again and again. So we see irrational exuberance followed by some sort of crash. So railway mania took place in Britain in like I said, in the 1840s. The Mississippi bubble is actually also a real thing, and that took place, as you can imagine, in Louisiana and Mississippi. And
during the Louisiana Purchase time frame.
Yep. So, and a gentleman who was a Scottish gambler by the name of John Law, couldn't go wrong there, right?
Yeah, that's a great place to start. Great place to start.
So he was tapped, and his idea was to create a paper currency that was backed by gold that had not yet been discovered.
They just assumed there was going to be all kinds of gold in that area.
That was going to be in Mississippi. Well, by me saying assumed, you can probably figure out what happened. But again, everything was bid up so high, irrational exuberance, that we saw a subsequent crash.
Correct me if I'm wrong. That was all to prop up kind of a failing economy in France.
Yes.
Because he was a French explorer.
Yep. So that
anyway,
it was France that had tapped him
to
come up with the brilliance idea. Tulip mania. So if you've been with us for a long time, you're probably sick of hearing about this, because I used to bring this up over and over and over again. Just to remind people that, number one, the stock market is actually a very young financial market when we look in the span of history. Nice.
My Hawkeye was crooked. I like it.
So the Dutch tulip bulb. So think about a tulip. We have a bulb, we plant it in the ground, it turns into a tulip. And those had caught the attention of many people throughout the world, and specifically in Holland or the Netherlands at that time. And so
they need to pick a name, by the way. Isn't that confusing? Do you want to be Holland or do you want to be the Netherlands?
To my kids. And, yeah, very confusing.
Or Dutch.
So the bulbs themselves got bid up so high because, yes, everyone was attracted to them, but in particular, there was some very wealthy people that were speculators. And what happened is they bid up the price of tulip bulbs to a point where the price of a single tulip bulb was the same as 2 horses, which is kind of crazy when you think about it from those terms.
Especially with how important horses were back then.
Yeah.
Less important today.
Yeah.
Right.
Or this is also a very Dutch thing, or I don't remember what the number was, but a massive amount of cheese. But these tulip bulbs were bid up to such a high value that a crash was imminent. And so that took place in 1637. And if you dig into this a little bit deeper, there's actually a differing opinion on this. So some people will say that it affected the entire Dutch economy, and a lot of others will say that it only affected those that actually invested in the Dutch tulip bulbs themselves. So we want to start off with this to give you perspective that this is not, volatility and this boom and bust pattern is not a new thing, and it's not just in the stock market. So that kind of just establishes the baseline for us.
It's also interesting when you think back through these, like the one that we're all at least familiar with, the Great Depression and the crash. And if you understand and you read about it, and you're like, gosh, these people were taking money out on margin, basically out on loan, money that they didn't have. They invest 100 grand, but only 10 grand of it was theirs, 90 grand was at the bank. They were leveraged 10 to 1. And doing it because of how crazy the markets were, and the markets had quadrupled in a 9-year period. And you look back and you're like, well, that was dumb. Like, how did they not see that was going to be a problem? And the tulip thing sounds completely ridiculous today. So does, basically creating a currency in gold that's yet to be discovered, or, the price of railway just exploding the way that it did. But it happens to us again and again and again, and we don't seem to learn from it, so to speak. I mean, prior to 08, 09, there wasn't a lot of people that were alive today that thought that housing prices ever went down, because frankly, this idea of a mortgage and owning a home really is a post-war thing. Mm-hmm. It wasn't that you didn't own homes, but you just built a home. Really not, there was no national builders. You just kind of built your own home when you could afford to build your own home. And so it had never really happened like that before in 08, 09, that all of a sudden we had this massive crash. And now looking back, you're like, well, okay, it's easy to see now that we were irrationally exuberant in the way that home prices were flipping. People were buying homes and 3 months later, flipping them for twice what they paid for them and all this kind of stuff. But we get into it now. Matt and I have opined about, Bitcoin and things of that nature. And of course, we can't predict the future. We have no idea, but it is going to be interesting to look back 10 or 15 years from now and wonder, is this going to be the same thing? Or are we going to end up being one of those like duh moments of, I can't believe we didn't see that coming? But bottom line is the boom bust, and understanding the fact that volatility in not just the stock markets themselves, but anything, commodities, services, things of that nature, it's been going on since before any of us were ever born or even thought about any of this financial stuff. So
I have a small quiz for you real quick.
Okay.
So one that I did not include on there was the Florida land boom and bust. There's a very familiar name associated with that. Can you guess who it would be?
Charles Ponzi.
Yeah, nice.
Ponzi scheme
Well
guy.
done. Yes.
Yeah. So that was right before the Great Depression, that Florida land just absolutely exploded in value, and they were selling land to people that had never even been to Florida.
It was in a swamp.
Yeah, swamp land. If anybody by the last name of Ponzi calls you and offers you something, don't go for it. He had already been busted for his scheme in the markets, and here he is with land in Florida, and people are going for it again. So, but people love to make money. Fear and greed, the number two largest emotions we have that drive our decisions.
You can listen to our podcast to hear more about that.
Question number 2, since 1928, how often does the S&P 500 move more than 1% in a day? Very evenly distributed answers here. Every 27 days, 20% of you said that. 14 days, 17%, 23% said 9. And the number one answer, 40% of you said every 3 days. The correct answer is, Matt, we're 2-0, man.
Yeah.
This is, I don't know that we've ever won.
We have not. No, I don't believe so. We've had a few.
We normally have 8 questions, like legit questions, and then 1 fun question. I don't know that we've ever gotten more than 4 where we stumped the majority of people.
I don't think so.
So far we're 2-0. The
pretty
correct answer here is every 9 days. So let me read some numbers here to you really quick. So since 1928, there have been 2,890 days of moves of greater than a 1% rise in the market in that day. Okay. There have been 2,776 days of moves of a 1% loss. So more days, 2890 of 1% or more, 2776 of a loss of 1% or more. Interesting though, of a 2% move, there's 741 days where the market went up more than 2% in a day, but 826 days of a move of 2% or more. So in the 1% move, we have more days that are positive than negative. In the 2% move category, we have more days that are negative than positive. It's the inverse or the opposite. And so what I think is interesting in that, Matt, is that emotions drive results in the short term. And obviously 1 day of trading is a very short-term result. And so when the markets start to move, emotions start to guide that fear component that we keep talking about. And you can't tell me that a lot of these major companies that are making up the S&P index, which is the largest 500 companies in our country, that there's fundamentally anything that changed about that company to the point where their stocks should be moving 2% in a day.
Right.
Yet it happens on a very consistent basis. Now, because of all these movements, you're like, gosh, Brad, that's a lot of days where we have consistent movements. It's interesting to me how you guys answered too, because the number one answer is every 3 days. I would say that's because of this last, that's recency bias. Yep. This last 6 months, we've seen it a ton where the market's moving more than 1% in a day. And so that probably drives your brain to think it's happening more often than it really does. But on top of that, from 1928, when this statistic started through today, well, actually, I only got data up until basically close to the end of 2020. The S&P index in and of itself, although it goes up and down fairly consistently, is up 19,721%.
Holy cow.
So had you invested 10 grand in 1928, it'd be worth $1.9 million today. So even though we have in the short term, these massive amounts of volatility, and it's also interesting because the indexes are so much bigger than they used to be. And so we were talking about this earlier too, with like the Dow Jones being over 30,000 today, a 300-point move, which feels like a lot, is less than a 1% move. Whereas when the market bottomed out in March of 2009, which wasn't that long ago, it was at 66.26.
No.
So had the market then moved 300 points, that's a 5% move in 1 day. Whereas today, that 300 points means less than 1%. And so 1, we have recency bias in our answer, in my opinion. And 2, the point movements seem much more material than they actually are because the indices are so much bigger than they used to be on a point value basis. But volatility, again, just going back to the point, has always been part of our markets and are very consistent. Every 9 days to have our markets move more than 1% is a very common and consistent thing.
Yeah, I think there's some more bias built in there that we're going to get to as we progress through this quiz as well. That why I think people answer, that it feels like it's more often.
Don't steal the thunder, Matt. Come on.
I'm not. That's all. Stopping.
Question number 3. Go ahead.
All right. Question number 3. Stock market corrections occur how often on average? 53% of you selected 7 years. 20% of you selected 2 years. 20% of you selected 12 years, and 7% selected 1 year. Man,
I'm almost starting to feel bad.
Yeah. This is somewhat of a trick question. So question number 3.
But even trick questions, I feel like our attendees normally get them right.
So this tells me that a lot of you are listening, but this is kind of a trick question because this is going to parlay into question 4, which is going to distinguish between what a pullback, what a correction, and what a crash are. So for those of you that answered 7 years, I'll say good job on listening, because that's something that we talked about, but that's actually a crash. So stock market correction is on average every 2 years. So we'll get to what the difference between each of those three are in the next question, but the correct answer was 2 years. And so just another fact with that, since 1928, there's been a pullback of 10% during the year, 2/3 of the time. I'm gonna repeat that. So just think about that. You're just promoting your book again.
Goodness sakes. We're on the struggle bus here, people. My screens don't match up. When I share one screen and it tells me what screen I'm sharing, it shares a different screen.
He's just trying to promote his book again.
No, I'm not. I want to share a graphic with you that's gonna, there we go.
All right. So this is something, again, I say, we learn stuff as we're going through this. We have a general idea of a lot of these things, but as we begin digging, there's so much interesting information out there, because this is something that's changing every day.
Yep.
It's moving up, it's moving down. There's millions of transactions. So it's just fascinating how deep you can dive into this and find different information. But this just shows from 1928 through the end of 2021, in each of those years. So 95% of the time we have a 5% loss or more, going down to the one that's most fascinating to me is the 20% or more is 26% of the time.
And that's during the year. That doesn't necessarily mean that we ended up the year down 20%. That just means from January to December, at some point in the year, there was a 20% pullback in the market. Doesn't mean the market ended at a 20% loss, but it is just very interesting to note that 25% of the time that happens, every 4 years, there's at some point a 20% pullback, and 2/3 of the time, it happens at least a 10% pullback in the market or correction happens. Pretty crazy.
Yeah. If I were to tell you you're going to take a pile of money, you're going to invest it today, and over the next 10 years, a quarter of those years, you're going to feel a 20% swing. That might make you feel a little bit differently.
Yeah.
So
it definitely drives emotions. And so like this year, who knows where we're going to end up, because it's only July. But obviously we're already in that 2/3 category where we're actually in that 25% category. One every 4 years, we have at least a 20% pullback. It happened in 2020. That was quick. Remember, the fourth quarter of 18 was bad. We had a pretty significant pullback there. But the bottom line is, this is very common. Volatility in the markets. We like to look at year-over-year returns, January to December, but a lot of people don't want to ride the ride in the middle of the year. We all like to look back and go, I love the long-term returns that the market offers me. And the fact that the S&P since 1928 is averaging almost 10%. I love that whole story. But then when you get into the granular and you actually have to live your life day to day, and you realize that maybe not, once every 9 days, the market's moving 1% or more. And then once every 4 years, it's got a 20% drawback. I mean, put that in perspective. You have $1 million portfolio, that's a $200,000 loss. If you got a $5 million portfolio, it's $1 million loss. Those are numbers that are just really, really hard to stomach. Mm-hmm. But at the end of the day, it's very, very common, number one. And number two, you snap that chalk line over the last 100 years and the market's up 19,000%. Market being defined by the S&P for our workshop today.
Yeah, I think it also goes back to just perspective. It's really easy if we go into any sort of chart, we're looking at historical numbers. When you zoom in, things feel a lot differently than when you take a step back and zoom way out.
Yeah. Yep. All right. Question number 4: a stock market pullback, correction, and crash are all the same thing. Wow. They came back with a vengeance.
Yeah, no kidding.
Came back with a vengeance. 100% of you said false. We were 3-0 at this point. It's now 3-1, but that one win for you was a dominating win. 100% of you said false. Yeah, it's obviously false. There have been 84 pullbacks in the market, which let me give you the definitions of the three. Okay. So a pullback is, where did I write all this down?
So pullback would be, that's 5 to 10%.
5 to 10. Yep. So we have a pullback at 5 to 10, a correction between 10 and 20, and a crash of 20% or more. Okay. So pullback 5 to 10, correction 10 to 20, crash 20 plus. Make sense?
That's why we tricked you in the last question. when I said correction. Sorry.
So since World War II, basically, there's been 84 pullbacks. So between that 5 to 10% range. Now, how many years has it been since World War II? About that many.
Yeah.
So it's about an every year thing. Almost every year, we're going to see somewhere between a 5 and 10% pullback in the market. And so that should just be built into your expectations. If you're in the S&P index, almost 100% of the time, we're going to see some sort of 5 to 10% pullback throughout the year. Okay. With an average of 7%. So 84 of them averaging is 7%. There have been 29 corrections since World War II with an average loss of 14% and 12 complete crashes with an average loss of about 35%. So those get pretty steep. It is interesting to me as well, Matt, when you look, everything we've been talking about is the S&P to this point, because it's the most well-known index, the most watched index. And so the S&P has a crash about every 12 years. Now, that's kind of been exactly what we've felt, right? Because it's been about 12 years since we had the last crash. I'm not saying that what we're in today is going to turn into a crash, because by definition, we're not there. Well, the S&P did cross that threshold technically, I guess, this year, but definitely not to the average level of 35%.
Yep.
But the NASDAQ and the Russell 2000, two other indices that people tend to watch a lot. Now, the NASDAQ, if you're unfamiliar, has only been around since 1971, I think. That's tech. It's all the tech companies. And then the Russell 2000 is small cap companies, capitalization. Large cap are the Microsoft, the Apples of the world. Then there's mid cap companies and smaller companies. Now, small isn't like Fiat. Small is like 2 billion or something to that effect, like small publicly traded companies. Russell 2000, there's a lot of companies that fall in that index, but the NASDAQ has a crash every 7 years. The Russell has a crash every 6 years. So while the S&P is every 12, the tech sector is every 7, the small cap is every 6. And most people that when we encounter them have diversified portfolios, which means you're not in all blue chip American companies. You're not all in the S&P. You've got some of your portfolio baked into tech specific and some of it baked into mid and small companies, international companies, things of that nature. And so it is unfair to look at the S&P and be like, I shouldn't experience this, but every 12 years, that's kind of the average. When in reality, there are parts of your portfolio exposed to much more volatile indices as well. It doesn't make them bad. In fact, the Russell 2000, we haven't seen a crash, since 0809 until this year. In that time frame, the Russell experienced it 4 times. It's had a crash of at least a 20% pullback 4 times, while the S&P never experienced it. So volatility is different in different segments, for sure, in the markets.
I think it makes sense to point one thing out here. If you're new to Fiat in general, if you're working with us, or if you're just on here as a guest, I think one thing that makes sense to point out is we're talking about general stock market indexes. So it would be really helpful for you to tune into a workshop, a podcast, or anything else to talk about a framework of how we actually build an investment plan. Yeah. Because the vast majority of our clients are not invested 100% in any of these things that we're talking about.
True.
So yeah.
True. All right. Question 5. Moving on.
All right. Using volatility as a measure of risk was first introduced in what decade? Do you have the definition of volatility written down somewhere?
I don't have it by the Webster's definition of. No, I don't.
We perhaps should have gone through that in the beginning of this to explain. I guess we kind of assumed that just was a basic thing. But when we're saying volatility, we're just meaning the movement of something in a certain time period. What are the ups and downs and what do those time periods look like? So this and over what span. So using volatility as a measure of risk was first introduced in what decade? 13% of you selected 1890s, 20% of you selected 1920s, 17% of you selected 1930s, and 50% of you selected 1950s.
You guys got 2 in a row. You're on a heater, as they would say. I actually thought this is one they would get wrong.
So did I. So the correct answer is the 1950s. So 50% of you
golf clap.
Correct. Yes. So Harry Markowitz wrote a paper in 1950 and
52, I believe.
Okay. So 1952, titled Portfolio Selection. And hopefully you've heard the name Markowitz, maybe maybe you don't remember it if we've talked about it before, but
you shouldn't have to know that. Don't listen to him.
He is the founder of modern portfolio theory. So you'll see his
He
name.
won some Nobel Prizes. Just kind of a big deal.
Yeah. But so it wasn't until the 1950s that they actually looked at this and said, hey, for any return that we're seeking, there's a corresponding amount of risk. And we do have a definition.
Courtney put it up there for us in the chat box.
The tendency of a substance to evaporate at temperatures. I think it might be the first one.
Okay, squirrel, back to the question.
So it wasn't until the 1950s where we actually connected those two things, where we said, okay, there's a corresponding level of risk to get a return, which is kind of amazing.
I think it's not that people didn't know it existed. It's just how do you quantify this risk adjusted return, or like for the amount of risk that I'm taking or the appetite that I have, what should I expect back from that? There was no quantifiable way to define that. There was no specific measures or like framework or anything like that until Harry Markowitz came along in the early 1950s. And then that was kind of the basis of what ended up being his modern portfolio theory, which was this risk adjusted return line that he came up with. And it's not like this, kind of linear graph. It actually looks kind of like a fish hook, where you start to take too much risk and it starts to actually decrease your average rate of return in a portfolio. And so it is something that portfolios get measured, even now, 70 years later, portfolios get measured against all the time. Is their risk adjusted return relative to modern portfolio theory? And are we kind of below the line of efficiency? Are we actually above the line of efficiency and adding more value, that kind of deal? But it is kind of crazy that it's just in the last 70 years that with any meaningful quantifiable data measuring, go back to like we were talking about the Great Depression earlier and 1928, 1929, and these people are losing their absolute livelihoods because they went to the bank and 10x'd their money on loan to invest it in the markets. And there's no data about risk at all and how much and what the volatility of that investment is going to look like. And they just had nothing other than kind of speculation and kind of what their neighbor was doing. Yep. Now we still live on that today. Now we have all the data we want, more data than we would ever need. And we still talk to our neighbors. We still talk to our friends. We still get kind of greedy. We watch people buy Shiba coins and Doge coins and, make some money. And so we still do it, but it was 70 years ago that this whole idea of, in a quantifiable fashion, allowing portfolio managers to have a gauge started.
It almost sounds like you're speaking from experience there.
No, I do own some. It's the same money I would play pull tabs with. If you don't know what pull tabs are, you don't live in Minnesota. I don't have them all over the country. They are a complete waste of money. Don't do them. I love them.
Very entertaining.
Yeah, it is a little square piece of cardboard that you rip a tab off, and sometimes you win money. Most of the time you do not. It supports the Delano hockey program.
There you go. Hey, there you go.
All right, next question. Question number 6. The name of the index that tracks volatility is, wow. 40% said VIX, 3% said fear, 43% said VOL, and then 13% said upside down. Is that what you were going for there?
Up, down.
Up, down? Okay, that's good. I like that.
I made that one up.
Yeah. This was very close, but chalk one up for the good guys. We got you. 40% of you said VIX. That's the correct answer, but you were outscored by the 43% that said VOL, volatility. Nice work, Matt.
So we're up 42?
We're up 42.
Yes.
We've never kept this close of track, but I think it's because most of the time we lose. So we don't really kind of keep score when you lose. It's like, it's a friendly game. Now all of a sudden it's not a fun and friendly quiz. We're winning. So it is VIX. And so the VIX index is actually something you invest in now. So in the 1950s, this idea of even measuring risk adjusted returns becomes a thing. And then by 1993, the VIX became part of the CBOE, which is the Chicago Board of Exchange. So, and then in 2004, they turned the VIX, which measures volatility, actually into an ETF so that you can invest in. So you can actually invest in volatility now, which is good and bad, right? It's good that we can kind of measure this and have a barometer, but the bad part is that when you start to bet on volatility and then volatility happens, it kind of becomes this like circular problem where it exacerbates the issue. Because if there are a bunch of people kind of betting on volatility and volatility happens and then that goes up, it causes even more volatility.
Yeah.
And so there's pros and cons to this kind of 2022 version of data that we have accessible to us. The fact that we can measure volatility, that we watch volatility, that there's become a norm, so to speak, for volatility of where the VIX stands. And I'll let you speak to kind of what that looks like.
So if this information is fascinating to you and you want to dig a little bit deeper, the VIX is something you can go onto Yahoo Finance and look the VIX up and see where this has been historically. Just to understand, a set point of 20, anything above 20 is considered, we're starting to see fear in the market, and anything below 20 is considered normal. And as we were digging into this,
and actually if it gets too low, that's not good either, because it goes the opposite way.
Right. So what did it get to? I think we found in October 2008. So just jump in a time machine, go back. If you remember, October 2008 was right about the time when Bear Stearns, his family.
Well, you turned on the news and you saw people walking out of office buildings in New York with their boxes and the empty trading floors at Bear Stearns and Lehman Brothers and things like that. Was kind of the height of the problem.
And it reached 89?
Midday, it reached 89. It closed the day at 70 that day, but the flux in the VIX in that one day was 450% in one day.
Which is crazy.
But it was up into the 70 and in midday, the 80 range, when 20 is kind of the norm. That's like having, your blood pressure is supposed to be, 120 over 80. And it's like all of a sudden it spikes to 4 times what it's supposed to be. Well, any human, we'd be dead, but you get the point. Like it's not supposed to be 4 times what was normal.
The other piece of the VIX that's important to understand, if some of you may be familiar with it, a really, really important distinction to understand is this isn't based on historical data, and this is based on future data, and it's a guess. So if you look at the VIX, it is projecting what is going to happen based on how many options contracts we're seeing. So all these millions of transactions that are happening, it's based on how many of those are options contracts that are being purchased. So there's no exact science to this, but it is something fascinating that you can watch and keep an eye on. I know Brad and I are both really big fans of the movie The Big Short, and so to explain the financial crisis 2008 and 9, if you watch that movie, you'll see one of the big issues was that a lot of these things were a derivative of something else. So it's taking something and packaging it and betting on it. And so when Brad talks about this being possibly an issue, you could say the same thing, because if I'm betting on more volatility, it's going to drive more volatility. So that same concern exists with that.
I liken it to prop bets. I don't know if you know what prop bets are, but like if you've ever bet on a sports game, even with just your buddy, and you're like, hey, Vikings, Packers, or wherever you're coming from in the country, whatever.
I don't know what a prop bet is, so I'm gonna learn something.
And normally you just bet on the outcome. I'll bet you $10 that the Vikings win the game. The prop bets are like, well, I'll bet you that the Vikings are up at halftime. I'll bet you that the first points scored are a field goal. I'll bet you that the first touchdown scored is a rushing touchdown and not a passing touchdown. Like, it's not even on the game itself anymore, in the outcome of the game. It's these little nuances of the game that are just kind of being repackaged. And so that, to me, maybe not a perfect analogy, but
that makes sense.
It's important to understand that the VIX is not looking at what already happened. It's looking at what it thinks is coming and measuring that. So not an exact science, obviously, because anytime you look into the future, it's an unknown.
That shows how much I bet.
What question are we on here?
Question number 7.
All right, here we go.
We're up 4-2, right?
Yes, we're up 4-2. Now that we're counting. It's a fun and friendly quiz that we're trying to win. One of the ways portfolio managers measure volatility is through the use of 17% of you said Sharpe ratio. 3, you can tell by Matt's smile that we won this question too already. 3% of you said alpha. 20% of you said beta, and the overwhelming majority of you said 60% of you said the PE ratio. The correct answer is actually Sharpe ratio. Let me just make my tally mark here. That gives us 5. Not only have we never won, like I don't even think it's usually close. Maybe there's better quiz writers,
maybe,
or worse quiz writers, maybe from their perspective. So the the Sharpe ratio is what one of the ways that portfolios measure volatility. PE ratio is real, alpha is real, beta is real. These are real terms. But to measure volatility, the Sharpe ratio, named after, what is his name, William Sharpe, or
I don't even know what his first name was.
I think it was William.
Sharpe.
I'm gonna go with William. He was the one that invented, but basically the Sharpe ratio allows, when you're looking at diversification, and you're not just gonna put all of your money in Microsoft or just all of your money in Tesla or something like that. And you're looking at buying a mutual fund or an ETF or a basket of mutual funds and a basket of ETFs, like a fully diversified portfolio. Of course, you're gonna ask yourself the question, is this actually adding any value to my long-term expectations and long-term rate of return? Because if it's not, then why would I do it? You don't diversify just to diversify. You do it because we think it adds value. And so what the Sharpe ratio does is allow us or a portfolio manager to try to quantify that a little bit. Now, I will pause here for a second and just tell all of you, if you're a family that works with Fiat, you know this. Matt and I are not the ones watching PE ratios, seeking alpha beta, watching Sharpe ratios, paying attention to the VIX on a day-by-day, second-by-second basis. We use brand name asset managers that are, have teams and teams of CFAs and CFPs and a bunch of other designations we probably never heard of, that have all the data and use all the data to build these diversified portfolios. Because at the end of the day, we're just convinced there's people that are smarter than us when it comes to this stuff. But understanding the fundamentals is important so that you can kind of give a grade to them.
Yep.
Like, so how do Matt and I grade these portfolio managers and what they're doing on your behalf? And so Sharpe ratio is a way that we can measure that diversification, and if that diversification is adding any value or if it's actually taking away from your expected rate of return. And so what the Sharpe ratio looks at is whatever return you got in your portfolio, let's just say it's 8%, you subtract the risk-free rate you could get. So in other words, like, what if I didn't take any risk? What if I just wanted to go buy something that had zero risk, like a government treasury? The one-year government treasury today is paying 3%. There is no risk in that, right? So I could get 3% with no risk. So if I got 8% with risk, I had to subtract out what I could have gotten without risk. And so I added 5% of value or return by taking risk. And then they divide that basically. This is the part where this gets hard to explain. They divide that by kind of the standard deviation or the movement or volatility that you took on in your life to go after additional return by adding risk to your life to see if it added value. Bottom line is, Sharpe ratios, if it's above 1, we added value. If it's below 1, we didn't. And so it's just a way for us to try to quantify this diversification. So, when we meet with families and we're talking about using a Fidelity portfolio or a Vanguard portfolio or a BlackRock portfolio or any of these big brand names, or maybe a lot that you haven't heard of as well, or using different positions, there is a way for us to kind of judge or give a report card to them, multiple ways, the Sharpe ratio just being one of those things. So
Where's Juan when you need him?
where's Juan? He's in Spain right now. Dale says we should give a copy of my new book to the viewer with the best quiz score. Unfortunately, Dale must be killing it right now. That's probably why he suggested that. Dale, I'm assuming you're batting 1,000. We can't tell what each individual answered. We only get to see the global results, Dale. But
honor system.
The honor system, yeah. So let's go on to question number 8. It's 11:54. Somehow, this always seems to end up where it needs to end up.
I don't know how it works. All right. Question. Okay. Question number 8. An iPhone that can fit in someone's pocket today is more powerful than NASA's first computers by what multitude? So before I go through the answers, I just want to, last month, if you joined us for a quiz, I like to throw this stuff in. I'm a big fan of future and thinking about the futuristic things and just being aware of what's going on around us. And Brad and I often get in these conversations as we're talking about historical context, just reflecting on how fast things have changed. And if you think about these little things we're carrying around in our pockets, when we graduated from college, no such thing existed.
You're talking about this,
so
by the way,
our iPhone, right. An iPhone or any other smartphone.
I don't know what other. I mean, you just said things we're carrying around in our pockets.
I said iPhone.
I know, but it was like 20 seconds ago, and I didn't want to make sure they were connecting the dots because maybe you still had like tiddlywinks and lint or something.
I might have some lint. Anyways, so just having that perspective on last month, we shared a quiz question about how many folds of paper it would take to get to the moon.
Yep.
Just to give us perspective on stuff. So I included this question 130 times, 17% of you selected that. 3% of you selected 50 times, 37% selected a million times, and 43% selected 120,000 times. Nicely done. You guys got it right. So an iPhone or any other smartphone that we carry in our pocket is 120,000 times has 120,000 times faster computing power than NASA's most powerful first computers back in the 1950s and 60s. So
Times,
yes.
compounded.
So I share that for a couple of reasons. Number one, when we talk about volatility, rewind back to the question where most of us got it wrong, and it felt like every 3 days we were having some sort of swing.
Yep.
The reason I wanted to include this in there is, as Brad mentioned before, we have so much information coming at us all the time, and we all have, or most of us have, access to all that information at our fingertips nearly any time.
Well, everybody on here has the internet.
So exactly. So a stat that I thought was fascinating. This came from the Pew Research Center. 97% of Americans own a cell phone. 87% own a smartphone. And the worldwide estimate is 83.72% of people own a smartphone. That is nuts. And
I think the craziest part of that is that there's 87% of Americans own a smartphone. 97% of them own a cell phone. What 10% of the people are walking around with a flip phone still, or the Nokia phone? Like,
I think I know.
I've never, I don't know any.
Some days I wish it was.
My wife's 94-year-old grandparents have a smartphone.
Yeah. This is just a simple fact that information is in front of us. So if you look at volatility over time, we've likely seen it continue to go up because we all react immediately. There's a great biography about Warren Buffett that is very, very long. So unless you're really into it and want to read it, then I wouldn't dig into it. But I believe it's called Snowball. I should probably double check. But in there, they talk about Buffett's method for making investment choices back when he was
James just got a flip phone. That boy James.
Back when he was first starting his investment career. And if you dig into that and listen to the process he went through, I mean, he had to go to the library, he had to check out the reference books. He'd sift through these giant books of reference papers to pick out what he called cigar butts. You compare that to today, where we can pull something out of our pocket as long as it's charged and find pretty much any information we want.
Yep.
At that speed, it's a completely different world. So that's more just a perspective question that I thought was helpful.
Well, and to summarize that before we get to the last and most important question,
I'm pretty sure
everything we've been talking about to this point is financial volatility and kind of what goes on in the markets and the history of that and what that looks like and how it's defined and how we can watch and how we can use it. This is emotional volatility, which a lot of these crashes in the past and things that happen, I mean, information just didn't pass the way that it used to. There's another really, really good book out there called The Lords of Finance. And it talks about the four central bankers that were in power kind of at the turn of the century and kind of the decisions that they were making that led to the Great Depression. And a lot of it was just because information. I mean, if the other three central banks were in Europe, the one was here. And if they wanted to pass information back and forth, they had to go on a ship, and so it's today, the emotional volatility we can go through because you can log into any website and get all these massive headlines around what's going on in the markets. And most of them lead with fear because it's the thing that elicits the most clicks. And you're going to read it and you're going to, intake all that information, and it's going to cause you a bunch of anxiety, drives more people's decisions than the financial volatility actually does. We know that there's financial volatility. We expect it. We know that it's coming. In fact, every single year since World War II, almost without exception, we have a 5 to 10% pullback in the markets. One every 4 years, we have a 25% pullback. We get all of it. It's all baked into the plan. It's the emotional volatility that we have to plan for. And it's actually the hardest part of our job, I would argue. So
absolutely.
Most important question, which by the way, you guys got that right. We are up 5-3. Let's see if you got the last question correct. We've won no matter what. Okay. We've secured the victory, but they're going to throw a 3-pointer from half court at the end to see if they can actually make it more respectful. Should we give it? I don't even know. I don't know if they've answered it correctly yet. Did you peek?
I just saw the first option.
Okay. What is Matt's middle name? 7% of you said Ralph. 10% said River. I love that anybody thought your middle name was River. 43% said Roy and 40% said Roman.
Roman. I like that.
They got it.
They did.
Dang it. It is Roy, Mr. Stahl, Mr. Stahl, Matthew Roy Stahl. Is there a story to Roy?
It's actually a family name. So it's been, I think I'm 4th generation Roy at this point.
Okay.
So, and we kept it going. So
which one of your boys is? Owen's a Roy?
Oldest. Yep.
Owen Roy. All right. Well, there you go. It is 12:01. We technically kept you long, but I'm gonna give you another dad joke anyway. Matt, I already asked you this. So you can't like give the answer.
Yeah.
What did Yoda say when he saw himself in 4K? What did Yoda say when he saw himself in 4K?
I don't know, Brad. What do you say?
HDMI. Come on, that's funny. Thank you all for joining us today for our fun and friendly quiz and the entire Inner Circle workshop. Make sure, I already told you, next month we're talking about Social Security, so join us for that. And then in September, that's usually around the time of the year that we talk about health insurance. And so we don't have it all planned out yet for September, October, but we will be bringing back up health insurance because it's open enrollment time for all of you Medicare people. And so stay tuned because we'll bring that back up again this year because it's just important every single year to make sure that we get that right. So as always, you know how to get a hold of us. You can go to fiatwm.com. All of our contact information is there. All of our events are there. All of our education content is there. The podcast, the blogs, everything else. Go check all of that out. Thank you so much for joining us. Matt and I really, really enjoy doing this. And you guys continue to show up every month and listen to our ridiculousness. Thanks for letting us win a quiz. Enjoy the rest of your day, everybody. See you guys.